As interest rates rose last year, technology stocks fell. And when stocks fall, they create a long-term opportunity. That's why we are talking today about ways that you can play technology in your portfolio via ETFs on the Toronto Stock Exchange. We'll be looking at such ETFs like the NASDAQ 100s. We'll be looking at covered calls. We'll also be looking at some alternative ways that you can add these names into your portfolio. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Before we get into the video, I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. Make sure to come back to the channel every single Sunday. We drop a brand new video. The first group of ETFs that we are going to cover are the ones that replicate the NASDAQ 100. These are the top 100 companies that trade on the NASDAQ and are typically tech related. So we'll go over to the Excel sheet that I created here, and we can see in this first category is the 5 players that I've been able to find on the Toronto Stock Exchange, and they consist of the same players. If you've been watching this series that we've seen before, your Invesco's, BMO, iShares, etc. And what we can notice is they have a varying degree of stock price, but we know that stock price doesn't necessarily matter, especially in this instance when it's tracking a particular index. We could see that they have a variance in dividend yields, also what it's costing to hold it, and more importantly, what we're going to see is that for a majority, they have a consistent performance because they're all replicating a benchmark. So it's pretty safe to say that no matter which one you pick on this list, you're gonna be a-okay. Breaking this down a little bit further, we're gonna jump and put all of these tickers into Yahoo Finance, and we can see here that there is a similarity between all of them, and there's one that kind of stands out, and the one that stands out is the iShares product, and that's because it's hedged to the Canadian dollar, and that's why you see it performing over the past 2-year basis on a negative performance. That's because the Canadian dollar has not done well in regards to the US dollar. When it comes to ETF investing, my personal preference is going with unhedged, and I just wanted to pull that out just for clarification and justification there. Jumping back, I did decide to put another one in this list that doesn't fall into that category, and that's the Invesco product that's QQEQ, and this product is equal weight. So we've covered this in the S&P 500 video, and when we look into the website at the position holdings, we can see here that they all have a relatively similar weight. And where this becomes beneficial is that if there are 1 or 2 companies that take up a majority of the benchmark, if they're 10 or 15% of the ETF and they happen to take a hit, well, that's going to overall ruin the performance. So with these, you're basically diversifying even more, making them all equal weight. It's a safer way to have the NASDAQ 100 in your portfolio. Just taking a look back here, jumping into Yahoo Finance, the yellow line is the QQEQ, and we can see here that there are periods of relative underperformance where the bigger names are kind of helping those NASDAQ 100 names move higher. But then in the recent months where we've seen kind of this downdraft or the stock market selling off, the yellow line happens to perform exactly with what the others are doing. So again, safer way to get into the NASDAQ. The second way to play this in your portfolio is by using covered call ETFs. And the most important fact to know here is that covered calls become super important when we have a stagnant market, kind of not bullish, not bearish, but just trending along. And we're kind of seeing patterns of that because the bulls take over. They think that the interest rates are going lower, so then the stock market goes higher. But additionally, we start getting these inflation prints, and it gives people a little bit of realization that maybe we're going to have higher interest rates. Therefore, the market gets a little bit bearish. The ETF owns the shares. They're selling call options in the future, meaning a higher price than it is today. They collect a premium and they pay you in yield. So that's kind of how they're going to generate yield, and it's something that we probably shouldn't hold during a bull market, but could be beneficial to us during a stagnant or even bear market. So as we take a look, there's not many names, but we do have 3. We have a CI Tech Giants covered call, we have a BMO product, and a Harvest product. And what we can notice here is that the dividend yields are relatively high. You're looking at 5+% in dividend yields. And when it comes to these actively managed products, so too are the MERs. So these are relatively higher than what we've seen in some of the NASDAQ 100 numbers. But throw this on your radar. I personally don't have any of these myself, but especially in the market that we're in today, it could be a decent way to get in, especially if you like dividends or yield in your portfolio. And the third category is alts or alternatives. These are ones that are not following a particular benchmark and up to the ingenuity of the ETF provider to add certain names in to outperform whatever index they're trying to outperform. The first one that stands out is the ARK Innovations Fund. This is one that is copying what Cathie Wood is doing, but it gives you a way to play it on a Canadian exchange. And the first thing that I'd like to say is that it's not on the TSX, it's on the NEO exchange, and the way we can highlight that is the .NE. Now this is one that has a lot of controversy surrounding it, whether it's Cathie Wood's trading personality, buying and selling shares, and then also we have the fact that it has been a poor performer over the past year, but we can't forget what it did when money was cheap, when interest rates were low. And if you believe that interest rates are going low anytime soon in the next 2 to 5 years, then this is one that could perform well. And we can kind of see with the market already thinking that rates could go lower this year. This has performed 31% year to date. Although I personally believe that we are going to be higher for longer on the interest rates, this is one just to consider and to do your own homework on. Another one that I have just learned about myself and find super interesting and wanted to highlight is XIT, and it's an iShares product. And some of the reasons that it stands out to me is that the year-to-date performance has been about 13%, which is relatively better than some of the other products that we've seen. And dating back over 5 years, it's compounded at about 18%. So I decided, hey, it's worth the time. Let's go into the ETF website and learn a little bit more. And one of the first things that stands out to me when looking at all of the holdings is that there's only 10. They're all Canadian, and it has a vast majority of Constellation software. And if you're not familiar with Constellation software, it's one of the Toronto Stock Exchange best performers. But one of the downfalls, it's $2,300 a share. And for those that are just starting in the investing game, it's very hard to buy multiple shares of this, and a lot of people are reluctant to just buy one. So if you're interested in getting exposure, it has about 25% of this ETF is invested in Constellation software. That's over $111 million. We also have some Shopify in there. We also have Descartes, Canadian technology. If you like it, if you love it, this is going to be your way to play it. So these are some of the ways that you can add technology into your portfolio. As for me, I have 2 holdings on here, the ZNQ, which is the BMO product, which gives me access to the NASDAQ 100. And then additionally, I have the TD product, the TEC, because when I was originally researching, this one gave me an overperformance as to what the NASDAQ 100 was doing. So it gave me a little bit more risk in there, and I let it up to TD to actually select which tech stocks I wanted to be in. And obviously the benefit of ETFs is that I don't have to go and buy all of these individual companies. I buy one ETF and it gives me exposure to all of them. So let me know your thoughts down below. Is there one on the list that I have not covered? Is there one in here that's your favorite? Leave it down below. I appreciate all your support, all your comments. And if you're still here with me, don't forget to hit that subscribe button. New content every single Sunday. I hope you all have a great week in the markets. Happy trading.